This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button or over Rory's picture saying, looking for the downloads. Now, I want to start off here, Nick, by having a quick peek at the crude oil chart. And it's been actually quite a bull run all year on the upside. But this morning, we got a bit of a sell-off at the time we're recording this. And we see almost a $2+ drop in crude oil. Though it is a bit of a steep drop, the interesting thing is that we still haven't seen any real technical damage on it. A move down into this 80 to $81, $82 area, so is where the 50-day moving average is, and so long as the bulls buy the dip, then we could see the bull trend resume right back up. I don't envision this spending much time below $80 on a sustained basis, and so with the sell-off already a few days in, I'm going to be looking for the buy-on dip there. But let's get to talking the S&P 500 because that's where all the action is, Nick. Let's start off with actually your levels.
Yeah, Patrick. Spot price on SPX right now is approximately 50.40. We have an implied move for the May 17th monthly OPEX of plus minus 190 points, which gives us an upper implied move of 52.30 near the highs and a lower implied move of 48.50 just above the previous all-time highs of 48.18 or so. Right now, we have key resistance at 5,100 and key support at 5,000. I'm inclined to think we see a further sell-off to the downside around that 48.50 area, because that would mark a roughly 9% decline from the high. What are your thoughts here?
Well, Nick, we've been talking for a month plus how the stock market was overdue for a correction, and here we finally have it. The selling is actually happening in an OPEX week, which typically could have seen some gamma pinning, but the selling seems pretty persistent, and we are the first time below the 50-day moving average since the November breakout. And so some sort of a correction's underway. The bigger question is what kind of a variety of sell-off is this going to be? Is this going to be just a typical pause in the price action and a sideways consolidation, or are we going to have a much deeper mean reversion? The first hurdle in my mind is on the S&P 500 around the 5,000 mark, and this is kind of relevant because that's a 50% retracement of its year rally from January, and that will line up on page 5 and 6 with the Russell and the Dow Jones coming back to their January lows. I mean, we now are seeing the Dow Jones index being a price-weighted index. You have it trading almost back to that January low, which really just shows the magnitude of this correction. And with the Russell, again, the small caps have been lagging all year, and how quickly the sell-off ensued. A lot of the breadth indicators are already down in the 25 to 30% levels, which just continue to show that this sell-off is actually picking up a lot of downside momentum. It'll be really interesting to see whether the support lines come in right along these lows. So moving on, though, to the Nasdaq, what are the levels you're watching here?
So in Qs right now, Patrick, we have a spot price of 427 approximately. We have an implied move for the May 17th monthly OPEX of plus minus 20 points, which gives us an upper implied move of 447 and a lower implied move of 407. Right now, we have key resistance above at 435 and key support below at 413. And as I mentioned in previous weeks, I'm selectively bullish on certain names, Apple and Google, while I'm bearish on the overall Nasdaq index itself. So last week we saw Apple pop up to around 178 on news of their for chip. That was short-lived as it pulled back down again to lows. But Google's been performing very well. Amazon has pulled off highs, as has Meta and Nvidia as well. So in the short term, I do think we see some declines across the board in the mega cap names. However, there are certain names that I do like. Those are Apple and Google, obviously.
All right, Nick, one of the interesting things that's been going on is obviously the substantial spike in implied volatilities. The whole year, the VIX has been trapped in that 12 to 16 handle. And finally, we're seeing elevated levels of volatility, not yet clearing into the 20 plus area, but it's been sustainably holding up here in the high teens as volatility premium is now substantially getting priced into this market. What are the levels you're watching?
So right now with the VIX at approximately 18, we can expect intraday moves top to bottom of about 1.2% roughly. And as we see volatility pick up, this makes for great premium selling way out of the money. But it's important to be very careful, obviously, because you can get burned very easily as the implied moves can be exceeded by the actual moves overall. So right now, volatility buyers have kind of caught on that insurance was cheap. And I think we're going to see perhaps a spike toward that 20 level. If we break above that, next stop possibly 25. But moving on to page 9, we have the US dollar index, which is now making almost year highs. What are your thoughts here, Patrick?
Well, the dollar has been in a clear uptrend, but it's not just the fact that the dollar has broken out, but it's actually the cross currencies that are driving it. The US dollar index, as it is approaching this 106 to 107 overhead resistance, is really mirroring the breakdown of the euro towards the 105 level. And that's where we're seeing some of that deterioration. But really, in the macro perspective, the one thing that I think is the most relevant was the material and breakout of the US dollar yen above the 152 level. Going back even multiple years, that 152 has been a huge overhead resistance. And on page 10, I have that chart. And what we can see is that was where the Bank of Japan was defending the currency quite consistently. And we find ourselves now distinctly breaking out with the US dollar now heading towards this 155 to 157 area, which are the first target zones above. But this is, I think, very significant because as the dollar is breaking out against this currency pair, it really can put in motion a potential risk-off impulse in the markets. The fact that this has been sustained for a week or more really means that this sell-off in risk assets broadly is not just a reaction to an overbought market, but is actually in line with a lot of the way the intermarkets behave during these risk-off cycles. Finally, Nick, I wanted to just touch on page 11, the US dollar against the Canadian dollar. And that was quite the breakout that we saw out of the consolidation. 136 was a level that I was watching quite a bit. And so with this type of a breakout, it really obviously is looking towards those October highs. But what are your thoughts in terms of how high the USCAD can go?
I mean, looking at USDCAD right now is kind of interesting, given that I'm a Canadian. Seeing the productivity disparity between the US and Canada is kind of astounding right now. And yesterday, Canada released their budget as well. I don't think that the Canadian dollar is going to see any strength anytime soon at all. US dollar, I think longer term, will head toward the $2 level against the Canadian dollar.
Well, you know what, Nick? I don't look out that far, but I'll certainly say that the trend is in favor on the short term of the US dollar continuing to rise. The bigger question, of course, will be what will happen when inevitably we start seeing economic weakness and which countries are going to be impacted the most. So it'll be really interesting to see at least whether or not this 140 level is achieved in the short term. I wanted to, though, move on to the gold chart on page 12, because what I find really interesting is that gold and the dollar have been rallying together in the last sequence. And that is not a typical intermarket relationship. Usually when you're looking at rates and currencies, typically your gold has very clearly had an intermarket relationship. But in this circumstance, we have gold that's just marching to the beat of its own drum. And even as risk assets start to sell a little bit, gold is resiliently holding up along these all-time highs near 2,400. I still still generally am looking for some sort of a pause in the advance, but I'm very bullish gold. So anytime we're going to see a $50 to $100 pullback, let's say towards 2,300, I view all of those as buy on dips that should be taken advantage of.
And moving on to the final slide, 13 here, with the 10-year U.S. government bonds. What are your thoughts here, Patrick?
It's been a little bit surprising for me to see the 10-year yield rising as much as it is, but the inflation fears have certainly caused the long bonds to start to react. At this stage, with this kind of momentum, it feels that the yields can head right back toward those 5% levels where they were back in October, November. Overall, though, I view that this should become still a substantial overhead resistance. So even if we do get up another 30, 40 basis points, I do think that that resistance level will still be meaningful, especially if we do end up seeing economic cracks start to show that could cause the Fed expectations of cutting sooner to potentially start to emerge again in these markets.
Folks, if you enjoyed Patrick's chart deck, you can find them every single day of the week with a free trial of Big Picture Trading. Just go to the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from bigpicturetrading.com, the Internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from bigpicturetrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.